If you can't answer these 7 questions, you're probably not ready to retire. Question number 1 is, how much do you need in retirement? And this is something that a lot of you struggle with because you've come to a point in your life where maybe you've just paid off the mortgage, you've just had your kids leave the house, you've just had a big financial event, and there's been a lot of movement in your financial world. So I encourage you to look either back a few months or start tracking a few months forward of how much you're actually spending. And I get it, as you get later in life, the budget kind of goes by the wayside. Most people in their 50s, 60s that are getting close to retirement don't typically live off a budget. If you do, great. But for the majority of you, you probably don't. But take an overall view of things. You could probably get a fairly good ballpark of how much you're currently spending fairly quickly. Now you can look at that budget and where your money's going to quickly figure out what will still be there in retirement or not. As a quick rule of thumb, a lot of people say you need about 70% of pre-retirement income in retirement. I always say let's get close to 100%. Unless you're a very high income earner, you may not need all that money because you're saving a lot of it. But if you can get close to 100% of your current income, or at least current expenditures, that's going to leave you in a good situation entering retirement. If you're used to spending $80,000 a year and you budget 50-55, that's a big lifestyle difference. And I get it, there might be some expenses that you currently can get rid of when you hit retirement, but there might be other expenses that you add on, more travel, hobbies, etc. So whatever you're spending as you get close to retirement, let's see if your retirement plan can sacrifice and support that type of income, at least in the go-go phase of retirement. And this is one reason I encourage you to get a retirement plan leading up to retirement. Most people reach out to our office and have our team put a plan together like months before, even early into retirement, which is completely fine. But if you plan ahead 5 or 10 years, or at least 2 to 3 years, you have a bit more runway. And that can A, adjust where you're saving money and maybe some tax efficiency, but B, you can kind of figure out what you're going to need in retirement, what you're spending. Again, it gives you that runway, which leads you into retirement in a better situation. Question number 2 that you need to have the answer to, and most of you don't have this answer, and it's probably the biggest issue, is when you hit retirement, how much are you drawing and where's that money coming from? And I just got an email before I started recording this, and it was from someone reaching out to our office. They got a plan by their current advisor at one of the big 5 banks, and I hear this again and again from all the big financial institutions of, yeah, I had my advisor do a plan, but I really have no idea. There's a bunch of charts, it's 85 pages long. There's really no data on where my money actually should be coming from. And I also don't know if it's efficient, which is a totally another question. But if you have a retirement plan and you have no idea where your money's coming from, is it really a plan? So as you get close to retirement and start entering into retirement, you need to know how much money you have, but more importantly, where is it coming from? And your retirement should have a clear outline of exactly where your income should be coming from, and hopefully you've gone through it with your advisor to know that it's the most optimal plan as well. But when we deliver a plan to our clients, they're getting both an Excel and a PDF of the plan that very clearly lays out year by year from current age all the way to age 95 or longer if they prefer. But every year, how much income, where it comes from, how much tax they're paying, their marginal average tax rate, like the detail is there and very easy to follow. Then our clients know how much income they have and where exactly that money needs to come from throughout their retirement. The third question you need to answer is, what is your income, and also the implementation plan of your income, or cash flow like some people like to call it. And that's really, I have a plan, I know it's really good, I know where my money needs to come from, but how do I actually structure stuff to provide me my income, to give me my cash flow, to allow me to enjoy retirement without stressing about everything that's going on in this world. And right now there's a lot going on, and a lot of you are very fearful of what's happening to your portfolio or what could happen to your portfolio. And if you're entering retirement, it's very stressful. And there's a way to remove that stress. And a lot of our clients will request from us, a Monte Carlo simulation, which is running a bunch of, rate of returns at different times and what if scenarios. Or they might ask for a sequence of returns, which is similar to that, saying, well, what happens if my portfolio drops 15, 20, 30% in the first year? Can I still retire? And our approach at Parallel Wealth is this, and I really encourage you to take this approach. And if you do this, it will ease a lot of your fears, if not all of them, around your portfolio in retirement. And that's, look, don't worry about Monte Carlo or sequence of returns or stuff that you can't control, right? If you run a sequence of returns, you say, well, yeah, if it drops 20%, maybe I can't retire. Well, you don't really know if it's going to drop 20%. It might be 30, it might be up 20%. You have no idea. These are things you cannot control. But once you have a clear plan and know exactly how much money where it's coming from, you can now create a plan around that. And I'll call it a cash wedge. Let's put aside 2, 3, maybe up to 5 years of income aside, not tied to the stock market. So if you can move, say, 3 years of cash flow aside, outside of the stock market, so if the market drops 20%, you essentially will have at least 3 years of income ready to go. So you're buffering the market. Yes, on paper, your portfolio is going to be less, but you're not drawing anything out of it. As you hit retirement, things do change, right? Leading up to retirement, if you had a market drop, it was an opportunity to invest at a lower cost base. But in retirement, we're not investing more money, we're actually drawing it out. And you definitely don't want to be selling or drawing money out of your investments when they're at a 10, 20, 30% loss. And trust me, throughout your retirement, you will see market drops many times over. So there's not a way to avoid it. There's not a way to plan or crystal ball it, but there is a way to forget about it. Create a plan that allows you to forget about it. I get you're going to get your statements, you're down 20%, it's frustrating, but you have this cash wedge over here that's providing the income, allowing you to put food on the table, to travel, to do your hobbies, to do whatever you have on your bucket list for retirement. Look, when the market drops 20%, because it will in your retirement, that should not slow down or derail your retirement. It should not change any travel plans. It shouldn't do anything other than there's a lower number on your statement that you have time for it to bounce back up. And when it does, you'll carve some of that money out to top up your cash wedge and get back on track. Again, we did a full video around this. You can check that up here. But you need to have a good cash wedge, cash flow plan once you have a proper retirement plan. And trust me, I've been doing this for 2 decades. This concept and theory and process will remove the fear around market ups and downs that you cannot control when you're in retirement. Are you looking for a smarter way to balance growth and income in your portfolio? Introducing the Harvest Balanced Income and Growth ETF, HBIG. This ETF is designed for both growth and income, making it a simple way to invest in a 60% equity, 40% bond portfolio. HBIG simplifies investing by combining 2 critical goals: steady monthly income and long-term capital growth. It provides exposure to leading large cap equities, high quality investment grade bonds, and a diversified holdings across key sectors like technology, healthcare, and utilities. Whether you're planning for retirement, saving for a major milestone, or simply building a more stable portfolio, HBIG is designed to meet your needs. What sets HBIG apart? It's actively managed by experts who apply tactical asset allocation strategies to help you achieve perfect balance between growth and security. Take the guesswork out of investing and choose Harvest Balanced Income and Growth ETF, your partner for steady income and long-term growth. Click the link below to learn more. The fourth question you need to have the answer to is, when is it the best time for you to start your Canadian pension plan and old age security? Government benefits. These are a big part of most people in Canada of your retirement cash flow. So when should you start it? How does it integrate? Again, we did a video recently about this, the integration of assets. Don't just look at what my break even is for CPP or when I feel like I'm gonna die, so I'm gonna take CPP early. Look, again, let's move CPP and OAS, but mainly CPP, it has a bigger impact. Let's move it from an emotional decision to a financial decision. And to do that, you have to have a good plan and really understand how your CPP, Canadian Pension Plan, integrates and works with all the other assets and income sources that you have for retirement. If you don't have everything working together, your plan's going to be a failure. You're going to write a big check to CRA every single year, more than you have to, and your plan could derail down the road. So make sure you have a clear plan around when is the best time for you. Again, everyone's a little bit different. There are strategies that work and some that don't work here. So make sure, again, you know how this integrates into your plan and when the best time to take your CPP and OAS is. And when it comes time to considering timing around your CPP and OAS, you really have to think, like, what are some of the concerns you have? Is it longevity? Is it inflation risk? Is it rate of return? Well, Delaying your CPP and OAS and utilizing those properly can alleviate a lot of that stress. So again, there's other peripheral items that needs to be involved in that conversation and planning to make sure that you're making the right decision for yourself going forward. The fifth question is, what is your estate plan? I always say there's two parts to estate planning when it comes to kind of financial retirement planning. The first part, your lawyer or notary should be putting together for you, and it's your will, power of attorneys. And that really says when I pass away or when I can't make decisions on my own, here's who makes those decisions, or here's who gets my assets when I pass away. Again, legal documentation. The other part of it, your financial planner should be putting together, which says, if there's anything left over, how do I make sure it goes to my loved ones or charity or whoever I want to leave the money to and not CRA? Many of you are not looking at that piece of the puzzle. A lot of you are ignoring that, and when you pass away, CRA is licking their chops because they're getting a nice check from your estate. And to avoid that, you have to do proper planning. I always say, a proper retirement plan takes three things into consideration. It looks at your cash flow needs, it looks at the tax planning, and it looks at your estate planning. And they all come together naturally through a good plan. Like, I cannot create a really good plan for a client where we've done really good cash flow and tax planning, but the estate planning has been forgotten. Like, it's all built in together. And so you need to make sure that that estate planning piece is built in. And if it's not, you don't really have a good comprehensive plan. I can tell you that right now. Make sure you have your legal documentation, but also make sure that your plan around whatever is left at the end of the day. And a lot of you might be planning, I'm gonna die with zero. Well, A, that's tough to do, but B, what if you pass away early? What if you live longer? Like, there's some estate planning there. Now, some of you might have more than you'll ever need, and that's a great problem to have. And maybe you're thinking, well, if we have more, can we pass money to our kids? Can we give to a charity? Can we help, the dog shelter down the road? Everyone's got their different thing to give to, but instead of just passing it all at death, can we actually give earlier? And then the underlying question to that would be, how much and when? And again, a good retirement plan could map this out for you. We do it all the time for our clients. Look, Joe and Sally, you guys have way more than you'll ever spend. We go through it with them. You're gonna die with $1 million, $2 million. It's a great problem to have. Not all of you are sitting in that situation. I understand that. But a lot of you are. You're never going to spend the money you've built up. So do you want to pass it at death? Would you rather pass it earlier? If yes, how do we do that efficiently? And if you need help with that, reach out to our office, parallelwealth.com/planning. You can learn all about our services. There's a link there to book a call with us. We'd love to chat and see where we can help you out and build not just a better retirement plan, but tax and estate plan as well. The sixth question you need to ask yourself is, have you planned for the unexpected? Now, one of the big unexpected is if you're married or common law, what happens if the other person passes away? Am I going to be okay? Or maybe you're the person in your household that runs the finances. You're watching this video? It's probably the case. Your spouse probably isn't too into this. You need to loop them in. But what happens if you passed away? Is your spouse or partner going to be okay? Both financially, and do they know what to do? Where to find everything? What the plan is? These are all pieces of the retirement that you need to make sure are in place. When we build a plan and present it to our clients, we always make sure both parties are there. If you're married or common law, we make sure both parties are there no matter what. Now, if you're single, obviously that takes it off. But again, are there people that rely on you? Or maybe you're single and you have debt. Like if you pass away, you're actually leaving a burden to someone. These are all considerations you need to think of. Like worst case scenario of a good friend, single person, has a bunch of assets. What's the estate plan? Also have another friend, bunch of debt. What's the plan? Like if you pass away, you're leaving that debt to family members. Do they know that? Could you maybe buy some insurance to offset that? So if you do pass away early, again, what is your plan for the what if? And that what if could be many different things. Two of the other big what ifs that we see are what happens if the market drops? And again, I covered that earlier. Cash wedge, have a good cash flow retirement plan. And then the investments need to line up with that. Put that cash wedge aside, 2, 3, up to 5 years of income, and that will remove that concern and hopefully allow you to sleep around that a lot better. The other one is unexpected large expenses. Now, I get it. We can plan for, well, eventually we're gonna need a new roof and this and that, but there's other expenses that come up. So you could stress test your plan. Well, what if I had another $20,000 or $30,000 expense at some point down the road? Like A, could I afford it? And B, where would that money come from? And that's why I like to A, have a good TFSA as you enter retirement. If you have an emergency, you can pull money out of there on a tax-free basis, not driving up your tax bill. Also, if you own real estate, It's another good reason never to dip into that real estate because a lot of people like to have it as a buffer for later on in life, just in case they need an in-home care or a care facility, but it's also a bit of a fallback and emergency plan just in case. Again, not a great option, but it's better than having nothing. The seventh and final question, and something that a lot of you still can't answer, is what are you retiring to? For many of you, you're working 30, 40, 50, maybe 80 hours a week. And as soon as you retire, that time is freed up. And so what's filling that time? And I've said many times on this channel, and I will continue to preach it to the, I'm done my career here, is you need to retire to something, not from something. And I get it. A lot of you can't stand your jobs. You have that date marked in the calendar and you have the countdown going. So I get it. You're retiring from something. You're done. You're burnt out. You're done with your job. But you need to find something to retire to, or else your retirement will actually burn you out faster than your job did. And I know that's hard to believe, but I've seen it like hundreds of times over with people. And that's why it's so important to find something to retire to. And that something could be absolutely anything. For some people, it's travel. For some, it's a hobby, volunteer. It doesn't matter what it is. Everyone has their thing they want to do. But what is that thing? Have you thought through it? Have you written it down? Have you started working on it, right? I've said before, if your thing is pickleball, but you've never played it before, that might be a tough sport to walk into. So what's the plan, right? Let's start playing it. Let's get in shape. Let's start moving in that direction leading up to retirement so that when you hit retirement, you can actually retire to that thing. Many, many, many of you are ready to retire. You're retiring in your head, you're retiring from something. But change that mentality of retiring to something. The benefit is you're retiring from something, but the goal is to retire to something. So if you haven't been able to answer all these questions, again, start working through them. If you need help with your retirement tax estate plan, maybe you got one done at your bank or financial institution and it's just not doing what it should be, it's not optimized, it's not really answering all the questions you have, reach out to our office, parallelwealth.com/planning. We'd love to help you out. We'd love to walk with you, build a plan, get it in place, and help you walk into retirement with a better tax plan, a cash flow plan, show you how to build a cash wedge. Make sure you're putting that hard-earned money back in your pocket and not Sarah's pocket. So again, reach out to our office if you need help with that. We'd love to help you out. See you in the next video.